Thank you for joining us today for Period End Financial Close Best Practices. This video will focus specifically on how to audit your accounts, receivable accounts, and your house accounts. Report and review. There are three factors that should always be at the top of mind. First is to review all the financial statements. By default, we are wired to focus on our profit and loss statement, but when conducting a period end close, it is critical that you review the balance sheet and cash flow statement as well. Accuracy in all three statements is essential in order to get true visibility into the financial health of your business. From there, identify where there are opportunities with accuracy and timeliness, and establish opportunities to support the coaching and development of your teams. When it comes to accounts receivable, it is critical that they are reviewed often because they reflect money that the restaurant is owed. In addition, balance sheet accounts roll year over year, so if the balance is not correct, the impact can be substantial. There are several activities that can cause an AR account to get out of balance. The most common is that only one side of the transaction is reported. Another common mistake is that amounts are booked to the AR account that should have been expensed. This is common with third-party delivery services when the fees are booked into the AR account instead of expensed. And lastly, when bank reconciliations are not answered correctly. Let's discuss what steps to take if you discover that a balance is incorrect when auditing these accounts. If the AR account is overstated, the best place to start is with your vendor. Request a transaction report so you can compare it against the trial balance to identify any incorrect coding or activity. Once the activity is identified, communicate any needed adjustments to your accountant. On the other hand, if the AR account is understated, review the trial balance with focus on missing or incorrect activity. Once identified, communicate any needed reclasses or adjustments with your accountant. In this example, the AR account holds a balance of just over $6,200. When drilling into the trial balance, you can see that the total amounts that are deposited into the bank differ from the amounts collected, which most likely represents the fees to the restaurant. In this case, the restaurant would get a transaction statement from their vendor, determine the fees, and have the accountant reclass the fees from the AR account to the expense account. Once complete, the AR account balance would only reflect what is truly owed to them from Grubhub. When setting up AR accounts, always take the time to verify with your accountant that it is set up properly based on how you are utilizing the AR account. In a situation like this one, we recommend reaching out to your vendor to discuss moving to weekly payments in order to eliminate the need for an AR account. Not only will this allow you visibility into your true expenses, but it will also increase your weekly cash flow. Now let's discuss house accounts. Much like the AR accounts, most house accounts reflect money that you are owed. Think of Norm at Cheers, who comes in every night, but only pays his tab twice a month. That, in essence, is what a house account is used for. There are four main activities that cause house accounts to go out of balance. First is when only one side is recorded. If you record that you are owed the money, but don't record when they pay you, this account will always hold a false asset value. Second, and most common, is when items are coded to a house account, but it will not be paid in the future. There's a vast difference between a house account and a comp. If you will not be paid back, set up a custom comp to track the expense to your business. These should not be marked as house account balance. It is not an asset to your business. Third is when transactions appear on bank reconciliation and are not coded correctly. And lastly, when the amount is paid in trade and not in money. This situation will require special setup and should be discussed with your accountant and tax specialist. If auditing the account overstated, run a tender report from the POS with all transactions close to the house account and compare it against the trial balance to identify incorrect activity. Once identified, communicate any needed adjustments to your accountant. If you find that the account is understated, then review the trial balance for incorrect or missing activity and communicate any findings to your accountant. Looking at this house account, we can see that it has a balance of $440. When drilling into the trial balance, you can see that while the tender has been used, no payment has been received, and the house account has been used over the course of almost 4 months. At this point, we would need to determine if this is a true house account and establish a payback schedule with our vendor. When setting up the house account, always verify with your accountant that it is set up properly based on how you will be paid back and verify that it is set up properly in the POS. If you will be paid back, it will be set up as a non-cash tender. If it will not be paid back, it will be set up as a comp and moved from the balance sheet to the P&L. Thank you so much for watching. Please reach out to a RASI representative with any questions.